Hello, this is the Steve and Sally Smith Income Tax Planning by Deanna Lambert. So the best practices I have chose, number one is remember the tax calendar runs from January 1st to December 31st. You can only claim something if it falls inside this time period, meaning if you did something December 30th, 2017, you can't claim it on 2018 taxes. And if you claim something you do a charitable giving on January 3rd of 2019, you can only claim that in 2019. Bunching deductions. You can pay early on an estimated state income tax bill or a property bill due early next year. You can also move things up, like if you have a charitable giving that you wanted to do in early January, you could go ahead and do that in December, and then you'd be able to claim that earlier than waiting till next year. The standard deductions have risen for the 2018 taxes, almost doubled if I remember right. So this is a good way to get to that limit. We want to max out retirement contributions. As a person under the age of 50, you can contribute yearly up to $18,500. If you are over 50, it increases to $24,500. We want to make sure that we contribute as much as possible because it's tax-free. If for some reason those are just way out there and there's no possible way you can do that, the best thing to do is to make sure that one, your employer matches your contribution, and if so, how much will they match? A lot of times it's like 3 to 4%, depending, or they'll do like up to 2%, and then the next 2% are half or something like that. You want to make sure that you're putting in at least that much. By doing so, they're basically giving you free money. They say you put in 3%, we'll put in 3%. They're giving you 3%. They're matching it. It's yours. So it's number one thing to make sure is being done. Keep good records. Being prepared is one of the biggest proactive moves you can do. Sometimes you got to keep these documents up to 6 years from the date you filed. But by doing so, you can make sure that if there ever is an audit, you have the papers, you can pull the papers, you can prove what you need to prove right away. If you throw them away or they get lost, you would really have to scramble trying to be able to prove that stuff. We want to watch our flexible spending accounts. The advantage is that the money that goes into the account avoids both income and Social Security taxes, which is a great thing. I mean, who wants to pay taxes if they don't have to, right? However, it's a catch-22. You use it or lose it. So you want to make sure that whatever you put into the account will be used by the end of the year, because otherwise it's no good. You just basically threw that money away. So you really want to look at what you're going to use it for, how much you're really going to need, and then stay on top of it to make sure that everything gets used before the end of the year. Avoiding kiddie tax. If you have a grandchild or child that you're wanting to give money to, we want to make sure that the amount is $2,100 or under. Otherwise, they get taxed at a rate that's very high, up there with like trust funds and estate taxes, and that kind of depletes the purpose of giving them money if they're going to be taxed at that high of a rate. We want to make up a tax shortfall with increased withholding. So we can estimate taxes owed or a refund, and then that will let us know if we need to increase or decrease withholding. So we can look at it and see that, you're going to owe the government money, and then we can increase withholding, and then they will take more out of the check to make up for that. We can also do like an estimated tax payment the same way. Roth IRA rollover is something we can do with the IRA. It allows you to pay a small amount of taxes now to roll it over, and then you don't pay any taxes later because it's a Roth IRA. It's important to note that withdrawals have to be made properly. If you don't do them how they're supposed to be, you will get taxed, and again, depletes the purpose of putting the money in there if you can't follow the rules. Also, if you look at it and for some reason you've had a loss, you can reverse it up to a year after the filing date, I believe is what it said. Charitable giving can be claimed if done before December 31st. So again, like I mentioned earlier, if you have a payment set up after January 1st, say that you want to give to the ASPCA on January 3rd, look at moving it up. Let's get it moved up and before the end of the year. That way it can go towards that year's taxes instead of waiting for next year. And report all income. Easiest way to avoid an income audit, make sure that everything gets reported. Even if you don't know if the interest on your savings account is income, bring it in. Let's look at it. We can figure it out. That way we know that's taken care of and you're not going to get audited on that. Excuse me. So recommendations are reporting all income, no matter how small. If you don't think it's important, doesn't matter, bring it in. Let's take a look at it. Let's figure out, make sure that all of our bases are covered to make sure that you don't get audited. As it says, we will be able to ensure that everything gets reported correctly and an audit will not be done based on income reasonings. So yeah, I mean, there's passive income, there's unearned, there's earned, there's a lot of different stuff. So just by bringing in all the papers, we can verify what needs to be done. Keeping to the tax year and bunching goes hand in hand. So this is actually like 2 and 3. Like I mentioned earlier, we can move charitable giving. You can do your estimated tax payments early. Anything, the IRA contributions, anything to get it into the tax year that you're in. So like currently we're getting ready to do 2018 taxes. Even though this is 2019. So anything I do now for myself goes into the 2019 tax year. I can't claim anything else for 2018 because that tax year has closed. IRA contributions and matching. I touched on this earlier. We want to make sure that if your company offers matching, you are taking full advantage. This is like the biggest way to earn free money. And I tell everyone, if your company offers it, even if you don't think you can afford putting 3% of your, 3% in, if they're matching it, you need to do it. It is so important. And then the last one is the rollover into the Roth IRA. As long as we think the withdrawals should be made properly, then it is actually a really good idea to move the IRA over into the Roth, roll it over, pay a little bit of tax right now for no taxes later. So when it comes to best practices, Steve and Sally are off to a great start. They have reported all of their income sources. They're keeping very good records. They've turned it in. We have a lot of information for their case. They've done a great job about reporting everything. I think we definitely need to look into bunching to figure out how they can get the biggest deduction and check into that matching program for the employer because that is super important.